Yeah, I welcome you all in the today's VCM on finance bill. And today we have amongst us CA Pradeep Kapasi sir, who is a very renowned speaker and he has a vast experience. So I welcome you, sir, and I request Ayaz
Thank
to
you.
just display his profile for a minute and then sir will start.
Sure. Sure.
Yes, sir, we can start, sir.
Yes. Yes, Shrutika. Yeah. Yeah. Good evening to all of you. See, my seniors and the fellow participants. It's my pleasure to be with you today on being invited to speak on Finance Bill 2022 within a very short period of just about less than 72 hours. This is perhaps, for the first time or second time, in my 30 years of public speaking on Finance Bill that I have agreed to speak on Finance Bill within the shortest time. Let me hope that yes, that I do my best and which is to your satisfaction. There are number of amendments, about more than 150, so therefore whether one would be able to really meet all that is required of me or not is something which we will have to see. Because of the largeness of the finance bill and the short time which has been placed before me, I would request you all to pardon me in case if you feel that there are some slips or lapses in the presentation. By the end of the time, I assure you that we will take care of it. As usual, what I have done is that I have in the PowerPoint, which is going to be shared with you in a short while, I have gone clause wise, that is clause by clause analysis, so that all of you who are attending this seminar, take away something which is relevant to him. And it's not possible for me to predetermine that this is only what is relevant for all the participants collectively. There could be few provisions, see, which would be relevant to all of us, but there could still be many which might be relating to some of the members who are attending this program, and therefore the idea has always been to share, and understand all the clauses clause by clause. As I said, see, there are usually you come across three kinds of speakers, see, who speak on finance bill. The one is the one who speaks after the finance bill is announced within the shortest possible time. The other one is people like me who take about a week, for the ideas to be understood. And there is a third kind of the people, say, who speak even before the finance bill is announced. And I would try to see that I am not one of them. Having said that, with this brief introduction, I once again, share my thoughts that it is wonderful today evening to participate in this seminar and share some of my views. With this background, say I may be permitted to share the screen, which is in the form of the PowerPoint, and that this is, there are several, slides which we would just flash and we would move together. This is the synopsis, see, which we have presented, which are I'm going to cover, about more than 20 different topics or subjects, which is covering almost all the amendments which are placed before you. So all these are about, as I said, these are about 20 of them, and we will take up one after another. The first one, of course, is the rate of tax. as far as the assessment year 22-23, the year which is just about to end, for which we will be shortly required to pay taxes. So far, advance tax has taken place, tax deduction at source might have taken place. So, as far as assessment year 22-23 is concerned, the rates of tax at which we would make the payment is predetermined by the Finance Act 2021, which is already legislated. So there is no change. It's not uncustomary that we sometimes see changes in the rates which have been prescribed by the previous Finance Act. Fortunately for us, as far as AY 22-23 is concerned, there is no change whatsoever in the rates, which have been prescribed by Finance Act 2021. This is one take home, we will keep it in mind. As far as AY 23-24 is concerned, that is the fiscal year which is about to join us, from 1st of April. There have been few important changes, not in the rates of tax, but in other related things. The first important amendment which has been made as far as the mathematics or the numbers are concerned is in relation to paying an additional tax for an updated return of income. It's a new scheme, a new provision which has been introduced through the Finance Bill 2022 for permitting all of us to file an updated return beyond the usual time which is permitted under the Income Tax Act. But presently we will just understand that this permission comes with a prescription, and the prescription is to make an additional tax payment. If you are updating your return of income within 1 year from the end of assessment year, you will be required to pay an additional tax of 25% of that income, that tax. And if it is in the second year, that is post 12 months, then in that case it would be 50% of the additional, to 50% of the tax that you will have to pay. So in short, you will pay the taxes plus you will pay the additional tax of 25% or 50%. It's up to you, right? The next amendment which is sought to be made is in relation to the alternative minimum tax which is payable under section 115 JC by society or any other taxpayer other than a company. Company pays MAT while others pay AMT in certain prescribed circumstances. Now in such case, now the AMT which was so far payable was 18.5%. To align that with MAT, now the provision has been made only in respect of cooperative societies to reduce it to 15%. So that's the second amendment. The third one is something which is the favorite of all domestic manufacturing company. Since a couple of years, the domestic manufacturing company, which is incorporated post a specified date, and if it is incorporated before a specified date, then in such case they are allowed to pay tax only at the rate of 15%, provided two conditions are satisfied, that you are a new domestic and manufacturing company. This rate of 15% there was a sunset clause for it, that all of them should be incorporated up to 31st March 2023. This date has now been extended to 31st March 2024. The next major amendment is in relation to providing the rate of tax for transfer of virtual digital asset, an income which arises on transfer of VDA, and that income would be taxed at a flat rate of 30%. Of course, to that you would add the surcharge and the higher education or the health and education cess. That's the word goes about. The next one which applies to all of us is that there is the surcharge on long-term capital gains of all capital assets, whether it was listed shares or whether it was transfer of units, now it is uniformly pegged at 15%. And in many cases of high net worth individuals, the benefit could range between 5 to 6% overall on taxes, which is a sizable benefit sought to be passed to the taxpayers like us on all long-term capital gains. The next one is again, a major concession which is sought to be given to a consortium which is taxed in the status of an AOP, wherein the members of the AOP are companies. Then in such case, the surcharge that is otherwise payable at 37% on a highest side is now pegged at 15%. So this again, ladies and gentlemen, is one of the welcome benefit for those business of doing business together with other people, and that consortium is a loose organization and therefore is being sought to be taxed at association of persons. This usually happens in cases of the tie-ups with overseas companies and the domestic companies for undertaking some massive, infrastructure or development works or projects. Howsoever, there is no reason that it should apply only in case of association. Even in case of, a mix of domestic companies coming together, constituting an AOP, this benefit of being tax surcharged at 15% as against 37% would be available to all of us. The next one is surcharge on a cooperative society is also reduced substantially from 12% to 7%. It seems this is an year of cooperatives, so therefore some important benefits are sought to be passed on to cooperative societies in the form of rates of taxes, rates of surcharge and AMT. So 12% surcharge is reduced to 7% provided the income of the society is in the range of 1 crore and is less than or up to 10 crores. Continuing with that is, having said this, these were the amendments in the matters of rates of tax. As far as assessment year 23-24 is concerned, other than the one which have been listed just now by me, there are no changes in rate structure prescribed, which was prescribed for AY 22-23. The entire rate structure is adopted even for AY 23-24. As far as individuals, HUFs, cooperatives, non-corporate assets is concerned, domestic companies, foreign companies, firms and LLPs, there is no change. Importantly, there is no change in surcharge also, and there is no change in cess also. So this is something, it is being said that in some years, no news itself is a good news. And in the matters of rates of taxation, other than what we have discussed, there is no news. And therefore, in COVID-19 times, wherein it is seen to be usual for many governments across the world, across the globe, to increase the taxes for meeting the medical expenses of the COVID-19 treatments. As compared to that, we are fortunate in this country that the taxpayers are not additionally burdened with some prescription like some cess or surcharge or any such other thing, not even by raising the taxes. So let us, enjoy this while the wind is good. Then these are just few tables which we have prepared. In your leisure time, you should be able to go ahead, look into that, and you'll be able to find out exactly that what is the rate of tax which a company or individual would pay, and what would be the taxation in respect of foreign company, dividend taxes and other things. This is just tabulated for the purposes of records, so that that nothing is missed in the matters of rates of taxation. So permit me to rush through this, so that because we have about 20 subjects and about 100 slides, so that as and when it is required, I would be pushing through some of the slides. So surcharge is there. These are the cases wherein the individuals, companies and societies are given an option to go for, the concessional rate of taxation. And in such cases, what are the rates they have been listed for your benefit. Then individuals and HUF, where you are opting for a concessional tax regime, what is the rate, and where you have not opted, a comparison is made for the purposes of under. Now we move to the finance bill, which deals with the provisions of Income Tax Act itself. The first we would begin with, as I said, we will go clause by clause, and therefore we will deal with all amendments on the way. Where they are not very important, I will pass by, and where they are important, we will discuss. The first amendment is sought to be made by withdrawing 4 important exemptions which were either to provided to non-resident foreigners who were working in India on deputation or on assignment under certain technical assistance program, largely between the government of India and a foreign country or any other foreign institution. Wherever these people used to provide services, whatever they used to receive, either as consultant or as an employee, the remuneration was provided to be, the provisions were made to not to tax such things by exempting it under various provisions of section 10. Now and there were benefits also for the family members from payment of taxes in respect of their overseas income, which otherwise was not accruing in India, but because of their stay in India with their relative who was an employee, then in that case they used to become resident of this country, and therefore their foreign income was also made taxable. In order to see that these people do not suffer taxes because of their option which they had exercised to stay in India, provisions were made to exempt this income. All these 4 important exemptions had long served its purpose, and therefore these provisions are now sought to be withdrawn with effect from 1/4/2022, that is AY 2022-23. If anyone who continues to enjoy this exemption for AY 22-23, they would not enjoy this exemption. The next is IFSC. If you would see that last 6 budgets, it's customary. It's customary to have amendments after amendments, mainly for granting reliefs, rebates, concessions in the matters of taxation to all those units which are located in International Finance Service Center, which is usually known as the gift city units. So these gift city units, see, whatever you do there, the intention is largely to not tax it. These are offshore units and they get benefits. As far as this country is concerned, they are assured that not a pie of their income would be taxed, provided they follow certain conditions. The idea is to see that, that India becomes a financial hub on the lines of Singapore and a few other countries. So continuing with the spurt of benefits which are being given, this year also 3 important benefits are being given. One is in relation to transfer income which arises on transfer of offshore derivative instruments, wherein the transaction is through offshore banking units of IFSC. Then in that case, the income would not be taxable, provided of course you are a non-resident. Similarly, if there is any royalty or interest is received on account of, hiring of ship or an ocean vessel or an engine of ship, in such cases to an unit of IFSC, it would not be relevant. I know that this has very limited application. However, as we have decided to go through, in order to be comprehensive, one is trying to do it. As the time unfolds, we will try to skip many of them. Similarly, see any income on portfolio of securities managed by a portfolio manager who is located in IFSC, and if the income accrues or arises outside India, such an income even though if it is considered to be otherwise taxable under the Income Tax Act, would not be taxed. A consequential amendment is made in the definition of specified fund relating to once again IFSC. Now the major amendment which we would take up now is that all of us, all and sundry, have been associated and have faced the practice of section 14A. 14A is a provision which disallows an expenditure which is otherwise legitimately incurred and which is otherwise allowable under Income Tax Act. Howsoever, such an expenditure is not allowed in cases where such expenditure is considered to have been incurred for the purposes of earning an exempt income. Exempt income meaning an income which is not taxable under the Income Tax Act. Like in the earlier year, dividend was not taxed, long-term capital gain was not taxed, and there could still be many income which are not taxable. So if you were to incur expenditure relating to such income, then in that case, such an expenditure would be disallowed in computing the total income. There had been a pertinent issue whereunder the courts were asked to decide that we agree with this disallowance. However, what happens if for a relevant year we do not have any exempt income at all? When I am not claiming any exemption, why would you disallow otherwise an expenditure which is lawfully incurred? And when I have not earned any income, at least allow me this expenditure. And the Supreme Court, in a series of decisions, some of them are listed, they are the recent ones. There are few which have been delivered earlier also. So in all those cases, the Supreme Court had very clearly stated that in the year in which you do not have an exempt income, there will be no disallowance, meaning thereby such an expenditure will be allowed to be deducted in computing the total income. The government of India does not like this, and therefore a bill is moved. This time a provision is sought to be inserted to provide that even where there is no income for which you are claiming exemption for this year, and this is applicable to the current year also, a large number of amendments are sought to be made for assessment year 22-23. In my view, they are nothing but retrospective amendments, because till the month of January I was not aware that whether this expenditure would be disallowed or not. I was rather sure that such an expenditure would be allowed. In my estimate of income for the purposes of payment of my first, second and third installments, I have taken full such case there is a difficulty, howsoever be that it may be. I would now, therefore, the government has provided an amendment which provides that if you do not earn any income in a particular year, that expenditure will not be disallowed. Simultaneously, an ultra cautious amendment is also inserted to provide that no matter whether you have an income or you do not have an income for which you are claiming exemption, we would, as Government of India, would not allow any deduction for any expenditure which is related to earning of an exempt income, whether received or not received, whether accrued or arisen or not accrued or arisen. This is the first major amendment in the matters of expenditure. The second amendment, which is a relief-giving amendment, it provides that in the times of COVID-19, if an employee or his family members were to receive some help for medical treatment of any COVID-related illness of employees or his family members, then in such a case, the amount which is received, if it is spent on medical expenditure actually, then in that case the entire amount would not be considered as a perquisite or a benefit, and therefore would not be taxable in the hands of the employee of the employer. It's further also provided that when assuming that a death results of the employee in COVID-19, and on account of that the employer is kind enough to give an ex gratia payment to the people, then in such a case also, the entire ex gratia would be tax free. This is first major amendment which is for which a press release was issued sometimes back. Now fortunately that press release has found a place in the law itself to remove any doubts whatsoever about its efficacy and effectiveness. The second amendment is also that when you receive any benefit or a donation, from any person whatsoever for the treatment of COVID-19, then in such case to the extent of 10 lakhs of rupees, such a receipt would not be considered as a receipt for the purposes of 56(2)(10). I'm sure all of you are familiar with 56(2)(10), and therefore I am not elaborating on that. In short, you know that you would not be liable to something which is popularly known as a gift tax. So even when it is received from any person, any institution, whether registered or not, if it is for COVID-19, it would not be taxable. Carrying further, we shift to this business expenditure. This is just a customary amendment. A mistake was made by the government or the legislature, which is sought to be corrected. It is requiring the donors to furnish a statement to a donee, and donee is required to upload it. If it does not do so, then there was a provision that in case deduction would be denied, which is now sought to be corrected. This is the other amendment is about explanation 1 to section 37. A new explanation 3 is being inserted in order to see that a raging debate since last few years is brought to rest, is something which is rested. The debate was about this, that ordinarily if you incur an expenditure or make a payment which is against the public purpose or the public policy, or on the payment of which is otherwise considered to be an offense or which is prohibited by law, then in such case such an expenditure is disallowable at the threshold itself by virtue of explanation 1 to section 37(1) of the IT Act. There was a debate in case where some of the regulatory bodies, say for instance Indian Medical Council, had issued certain circulars, say for instance in 2009, whereunder it has advised its all members, that is largely number of medical practitioners, that is doctors, requesting them or asking them that they are prohibited from accepting any benefit or a perquisite in cash or in kind in the matters of hospitality or overseas tours or domestic tours and gifts and so many other things from pharmaceutical companies. According to Medical Council, it was considered to be unethical, and therefore it was prohibited under a notification issued by the council, which otherwise is a recognized Government of India recognized body. The issue which arose that in the hands of claiming this expenditure, which at times ran into hundreds of crores on provision of such hospitality to the doctors and medical representative. When the matters went to the courts, the high courts held that such an expenditure was not allowable by virtue of explanation to section 37. Howsoever, the tribunals following some of the dictate of the first tribunal, which had held that that it is for medical council to regulate medical practitioners, but medical council had no business to regulate the pharmaceutical companies, and pharmaceutical companies, it was not prohibited for them to have made such payment or incurred such expenditure. Realizing this, the tribunals after tribunals had been holding that such an expenditure was allowable as a deduction in the hands of the pharmaceutical companies. There was another issue also in the context of this explanation itself, very explanatory. That this provided that yes, if payment of any money or incurring an expenditure which is prohibited by law, then it should not be disallowed. There was no disagreement on that. Howsoever, isn't it that such restriction should apply to violation of the domestic law and the payments being made thereunder? So assuming that if you violate some of the provisions relating to Motor Vehicles Act in India, the payments which you would make would be disallowable and there is no disagreement on it. But if you were to pay some huge sums, say in class litigations, class suits or such other things, for violating the laws of foreign country, and you are asked to make payment in those countries, whether those amounts would be eligible for deduction or not. And the tribunal, especially the Mumbai tribunal in two famous cases, held that the restriction of explanation 1 to section 37(1) applied only in relation to violations of domestic laws. To overdo both these cases, it has now been provided in the Finance Bill 2022 that if you were to make any payment which is in violation of any regulation provided by any domestic authority like Indian Medical Council or any such other similar bodies, then in such case that would not be allowed as a deduction. It would be considered as in violation of 37(1). Similarly, it is also provided that if you make claim of deduction for an expenditure for payment made outside India for violation of domestic laws, that too would not be allowed as a deduction. The conflicting decisions are placed in this, captured in this slide, so kindly look into it at your convenience. The next major amendment in business expenditure taxation is that when you make a payment of education cess and surcharge in addition to income tax, whether this education cess and surcharge are allowable as deduction or not, whether they would be construed as payment of taxes. If yes, then provisions of section 48(2) small 2 Roman 2 would apply, and therefore there is an express disallowance in respect of such a payment. Howsoever, over a period of last few years, a consistent attempt is being made by the companies, and rightly so, that this cess and surcharge, or at least cess, should be allowed as a deduction, because such a cess is not a tax within the meaning of tax which is defined under section 2 subsection 45 of the Act. Bombay High Court and Rajasthan High Court have held that the claim of the assessee is correct, and therefore whatever cess which at times can run into crores of rupees is allowed to be deducted. Howsoever, recently a Kolkata tribunal, distinguishing this decision with that of a Supreme Court decision, which is also placed in the slide, held that such a cess is not allowed as a deduction, because in view of the Supreme Court decision, this cess is nonetheless not allowable as deduction, for the reason that this cannot be considered to be a business expenditure. The understanding is that I would get a deduction on when I satisfy two conditions. One is that it is not a tax, and the other one is that it is a business expenditure. While you might succeed in explaining that it is not a tax, you still may not succeed in proving that it is a business expenditure tax. It is a business expenditure, and then that view of the matter, there is a difficulty in claiming such an expenditure. This difficulty is now pronounced and is something which is now glaring in the eye with a retrospective effect, an amendment is sought to be made which relates back to year 2005, 1/4/2005, and such a cess whenever claimed, would now be disallowed. So wherever there would be possibility of reopening an assessment, then in such cases it may be correct for the assessing officer to 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 reopen the case and thereafter proceed to disallow. So these are the decisions. This is the circular which is placed before you. Kindly refer to that. That is the business expenditure amendment. The third amendment in business expenditure, once again a substantial one, is that all of us are aware that certain payments, though business expenditure, are allowed as a deduction only when the such expenditure is actually paid. Only incurring of such expenditure is not sufficient. So therefore, government had provided a list which was ever expanding to say that, a deduction would be allowed only when the paid. One of it was in relation to interest which was being paid on loans, borrowings or advances, wherein the borrowings were made from financial institutions, NBFC or banks. Such an interest when it was not paid was still being claimed as a deduction. On one side, the company was not paying the interest for several years and it accumulated into crores of rupees. And on another side, this interest was claimed as a deduction, depriving the government of the taxes. However, that was the law, and therefore I did not find that claiming a deduction by itself was something not ethical. But the government did not like this practice, and therefore some years back it introduced, three explanations in the form of 3CA and 3D, which provided that in cases where interest which is unpaid and which was accumulated, if it was converted into loan, then in such cases the conversion of a loan would not be considered to be the case of an actual payment on the pretext that it is a deemed payment. There had been courts which have been upholding such a treatment and allowing deduction. Lastly, there is a recent Supreme Court decision also which upheld this practice in the context of conversion of unpaid interest into debentures. And the reason for Supreme Court to hold that 3C, 3CA and 3D explanations would not apply for the reason that they provided for conversion of outstanding interest into loans, borrowings or advances, and not in debentures. This was Aqua's case. In this was that they had issued debentures to those creditors to whom interest could not be paid. And Supreme Court was quick to allow this deduction. Once again, the government of India did not like such a decision, and therefore seeking to overrule such a decision has now proposed to provide that even where outstanding interest is converted by issue of debentures, provisions of 43B would come into play, and such an interest will not be considered as having been paid and allowed as a deduction. The next is capital gains. Both are consequential amendments. These amendments were made in 2021. Government, in 2021 seems to have made lots of lapses, and fortunately the government is kind to accept that there were lapses which it should be allowed to rectify. So they have all been rectified with effect from 1/4/2021. One such amendment is in 2 subsection 42C, and the another one is 50, which has some tax implication. So permit me to present my views before you. Is that previous year it was provided that goodwill would not be entitled to depreciation, and therefore the same was required to be reduced from block of asset for the purposes of 43(6)(c)(2) big B. This is what was the amendment. A parallel amendment which should have been made in section 50 was not made. which is now sought to be so provided that in case where the WDV was reduced, was pulled down on account of the write-off of goodwill from the block of asset, such bringing down of WDV would be construed to be the case of a transfer. One would not have any difficulty for the purposes of section 50. So eventually when all the assets of block are being transferred, there would arise a liability to pay short-term capital gains tax as per section 50. But this innocent looking amendment has an impact that if writing off the goodwill in the block of asset, if it is considered to be a transfer, and the block of asset is entirely negatived and is resulting into a negative balance in the block of asset, there can arise a liability to short-term capital gains for which no apparent answer is possible. Howsoever, I would believe that this is a mathematic exercise which is not actually resulting into transfer of goodwill, and therefore in such cases the taxation, if any, should be deferred to the year in which the goodwill is actually transferred. Even though you have now provided for a fictional transfer, in the year in which there is an actual transfer, till such time there should not be any taxation of short-term capital gains, even though the block is resulting into a negative value. But this is something I am sure that the representations made to the government would appropriately take care of such a thing. Cash credits is a major amendment which applies across the number of taxpayers, applies to almost everybody who is in the habit of crediting its books of account with loans, borrowings and other cash credits, or even share capital or partners capital and such other things. Ordinarily, famously, Madras High Court almost 80 years back in Hastimal's case provided that an assessee is required to prove the source of his credit. So when I borrow some amount, I have to show that I have borrowed such amount from XYZ, and having done so, I have to prove his credit worthiness and I have to establish that the transaction was genuine. As long as XYZ is otherwise an identified assessee or a person, my compliance with section 68 stood satisfied. That is what Madras High in Hastimal's case. Meaning thereby that I was not required to prove the source of XYZ, a person who had lent me the money. So which is in our circle is known as source of source. Courts consider them to be a source of source, and source of source was not required to prove. This went on for years together. Then somewhere in the first decade of this century, there came series of Supreme Court decisions which said that such theory applied even in respect of share application money, share capital and share premium. This was the time in the post-liberalized era, there were lots of companies which were crediting share application or share capital money without having a clue as to from whom the money was coming. And Supreme Court was, kind to companies, wherein Supreme Court said that they were not required to prove the source of source. So there came an amendment of 1/4/2013, which clearly said that in the context of receipt of share application, share capital and share premium or similar such payments, the company was not only required to prove the source of the share applicant, but also required to prove the source of the shareholder himself. So shareholder himself or herself. This amendment is considered to be prospective by Bombay High Court, but the government realized that after its success from 2013 onward, wherein this amendment is not knocked down, the government this year is encouraged to now introduce a clear-cut provision stating that in respect of all cash credits. In respect of all cash credits, need not be cash itself, any credits in the books of account, and which is not in the nature of income otherwise, then in such case, the borrower would be required to establish his source and also the source of his creditor also. So a source of source is required to be established. And fortunately this amendment will take effect from AY 23-24 and would not apply to the current fiscal or the current assessment year 22-23. 2 or 3 exceptions have been provided in the form of venture capital schemes, venture capital companies, and other regulated entities. In such case, the source of source will not be required to be proved by these VCs. But in all other cases, take this amendment with a great caution, for the reason that it will apply to all persons, who are in the habits of borrowing. In all such cases, as and when you borrow, you have to put the lender to a notice that he would be required to establish not only, my source, but his source as well. In short, a lender will have to establish that the money which has come to him is also legitimate and is also meeting the test of section 68 otherwise in his own. The next one is again a major amendment which is sought to be made to put to rest a raging controversy which is there since 2016. There is a provision called 115 BBDE which seeks to tax an undisclosed income at a fantastically highest rate of about 83%, 76% plus penalty and such other things. Now, in such case, the controversy was that if undisclosed income was taxed under a specific head of income, say for instance PGPB, that is profits and gains of business and profession, then in such a case, should it not be such that such losses of such business should be allowed to be set off against undisclosed income which is offered for tax under 115 BBDE and which is otherwise taxable at a maximum rate, a phenomenal rate. The tribunals have been consistently taking a view, relying on one Gujarat and one Madras High Court decision, stating that in such a case, such an undisclosed income would first be set off against the losses and the balance, if any, will alone be taxed at the highest rate. This is what had been the understanding. Taking a clue from this, the professionals, the practitioners were encouraged to advise the clients that this rule should apply even in cases where an undisclosed income is declared during the course of search, during the course of survey. Such an income, if it is considered to be an undisclosed income, even though the source and the manner of earning has been specified, this would be considered largely as an income in the sphere of section 68 to 69D, and therefore such income would be brought to tax at the higher rates. This is what had been the understanding. Howsoever, the advice of the professionals was that an attempt should be made to set off losses, including the brought forward loss, if there are any, and the attempt should be made to see that such an income is finally taxed under the head profits and gains of business or profession. So this had been, in spite of a dissenting Gujarat High Court earlier decision, the view which was emerging was that in the matters of losses which are legitimate, please allow the set off, and that is what perhaps was the correct understanding of the law. Once again, the government was relying on an express provision in 115 BBDE which stated that no losses would be allowed to be set off against such undisclosed income. In spite of that, the tribunals have been consistently allowing this at all. In order to bury this hatchet, now a special provision has been introduced in the form of Section 79A. In the form of Section 79A, which now provides that such losses, even though legitimate, would not be allowed to be set off against such undisclosed income, period. Then there is an amendment in Section 79 which applies to the losses of the public sector undertakings, like Air India is a recent company which has been taken over by a Tata company, Talcel or some such other company's name. And the issue would be that whether the losses, colossal losses of Air India of about 18,000 crores, whether the Tata company would be entitled to carry forward or not. And I believe that this new amendment in Section 70 is seeking to see that that such losses remain intact and are allowed to be the losses of the erstwhile PSU, which now is no more a PSU. Then in such cases, as long as the original investor continue to hold 50% stake in so converted PSU, the losses will continue to be allowed. This perhaps is the understanding of Section 79 amendment. Chapter 6A deductions, these are regulatory discussions. The first one is a simple amendment that central government employees were entitled to claim NPS deduction in respect of the contribution of the employers to the extent of 40%, to the extent of 14%. However, state government were permitted to do so up to 10% only. Obviously, this would first become the income of the employee and thereafter a deduction would be claimed under Section 80 CCD. So now it has been provided that state government employees are put on par with central government employees. I hope someday simple people like us also are put on par with government employees. As it is, they are privileged people. They are enjoying the best of the services and the facilities in this country. The next amendment is in respect of Section 80DD, an important amendment. What the present prescription of 80DD provides, that when you make a payment or deposit with an insurance company including LIC for the purposes of deriving the benefit of annuity on death of the person who has deposited the money, and the annuity is for the benefit of a disabled person, then in such a case there would not be, then in such a case the person would get a deduction for this. Howsoever, in cases where the benefit of annuity was to be received during the lifetime of the depositor, then in such a case the benefit would not be allowed. The policy was so structured. So the first amendment which is so provided is now that even where policy provides for the payment of annuity during the lifetime of the depositor, the sponsor of the policy, as long as the provision is for payment of such annuities post 60 years of his life, and the payment or the deposits are otherwise discontinued, then in condition on satisfaction of these cumulative conditions, the payment under such a policy would be eligible for a deduction of 75,000, which in extreme cases can go up to 1,25,000. It's a very welcome benefit. The other amendment, which is also a beneficial amendment, which now provides that even during the lifetime of the depositor or the sponsor, if the beneficiary, that is the disabled dependent, starts receiving annuities, such annuities would not be taxable in the hands of the recipient, even during lifetime. So in both cases, these are beneficial amendments, and the amendments have been made because of Justice Sikri of Supreme Court who, in reviewing a matter relating to the payment under such policies, had made observations that this could create serious issues if the policies were to provide for non-payment during the life of the sponsor. So therefore, to take a positive approach out of the Supreme Court decision, this welcome amendment. The third is startup. It is a never-ending change which is being sought to be made year after year because the government really wants to support these startups. There was a sunset provided for startups as on 31st March 22. Now it has been provided that any startup which is incorporated up to 31st March 2023, it will continue to enjoy the benefits for 3 years out of 10 years for 100% of the profit under Section 80 IAC of the Act. The next is an interesting amendment, though may not be applicable to large number of people. It's about bonus stripping and dividend stripping. There are existing provisions which discourage 94(7) and 94(8), which discourage dividend stripping by 94(7) in respect of units and securities, and there is 94(8) which prohibits bonus stripping losses in respect of the bonus. So these provisions are found to be lacking, especially 94(8) was found to be lacking by the Pune Tribunal and also Bangalore Tribunal to hold that in case of bonus stripping, this law, because 94(8) was not providing for losses arising on transfer of securities, therefore such losses, even though the cases of bonus stripping were allowed to be set off. To do away with this, now there is an express amendment which is made in 94(8) to provide that not only in respect of unit bonus stripping, but securities bonus stripping, which includes shares also, there would not be permitted, you will not be permitted to claim the losses, to ignore the losses, which losses would become part of the cost of acquisition of the bonus shares which are continued to be held, bonus securities, bonus issues wages. The other amendment which is sought to be made is that, and this is made in 94(7) and 94(8) too also, that there are pool vehicle investments, pool investment vehicles like REITs, InvITs and AIFs, which are not otherwise classified as units of mutual fund for the purposes of income tax and also purposes of the SCRA and many other acts including SEBI. And therefore, in order to do away with that difficulty, it has now been provided that even where there is dividend or bonus stripping exercises in respect of InvITs, REITs and also AIF units, in all such cases, whatever losses you make or whatever dividends you earn, which is otherwise exempt, it's only when a dividend is exempt that 94(7) would apply. Be that it may be, what is now provided is that government is responding very, very quickly even to the tribunal decisions, and is year after year is coming out with amendments which government is in the fashion of saying that they are clarificatory amendment, though most of these amendments otherwise are prospective amendment. The one interesting or much talked about amendment is about virtual digital asset. In effect, the two important assets which are presently in practice and which is normally being invested or which is being talked about, and those investment vehicles, one is cryptocurrency and the other one is non-fungible tokens, and there could be few other non-fungible or fungible tokens which also have aroused some interest of the investors, especially the high net worth individuals. The issue which has been biting since the time the crypto phenomenon had crept in was that what is the tax treatment in respect of this crypto? because they are otherwise digital currencies, and the government would like to call them as virtual digital asset, and which has been exhaustively defined. I must compliment the government for having done that, they have not missed most of the things which could have otherwise been covered, as a virtual digital asset. And it also covers cases wherein payment for acquiring this virtual digital asset is made by some other virtual digital asset. The sum and substance of this is that if you derive any income on transfer of this virtual digital asset, it would not be taxed under the head capital gains. It would not be taxed at the concessional rate of tax under section 112, even where the cryptocurrency is held for more than 12 months or 24 months or 36 months. What is now sought to be provided is, and that is with effect from subsequent assessment, fortunately, is that the income that would arise on transfer of a cryptocurrency or an NFT, the non-fungible token, then in such case, such an income would be taxed at a flat rate of 30%. And as if this is not sufficient, then it is also provided that no deduction for any expenditure or allowance or no set-off of losses would be allowed, but for the cost of acquisition that would be allowed in computing the income from these. So if you were to make some losses in relation to transfer of cryptocurrency in the year 1 of a fiscal, and if you were to make some profits in the year 2 of fiscal, there is a possibility that these losses which you made in the first month would not be allowed to be set off against these. There is a possibility that that if you have an income which is below the threshold limit and enjoys a tax exemption, in such case also this 30% taxation could be activated, like which is done in the context of section 111A for taxing short-term capital gain without set-off. So these are the cases, which one will have to take it with a pinch of salt. The only issue which I could think before placing before you in this context, before I take you to the second and third amendment on this virtual digital asset, is that if you are in the business of trading and therefore you transfer a cryptocurrency, and if you have an income, the amendment would apply. I do not have much doubt on this. However, what would happen if I am in the business of manufacturing cryptocurrency? By making massive investment in the systems which enables me to be a participant, a major player in manufacturing cryptocurrency. Those of you who have looked a little into it, I am the one who has not looked much into it, but whatever I have understood is that it is possible for you to manufacture a cryptocurrency by series of software employments and hardware employments, and incurring substantial expenditure, incurring substantial time and energy. You might come to a day wherein you could be considered to be an automatic owner on manufacturing of a cryptocurrency. Now, this is not prohibited. You are all welcome to join the party. Now, in such cases, the issues could be very different. The expenditure could be substantial. The depreciation which is which would be, which would have taken place also would be very substantial. In this case, I would believe that the present prescription of amendments is falling short to this. The other place wherein it is falling short is that what would be the taxation up to AY 22-23. The government has not provided that this amendment which is sought to be inserted is retrospective. It is not. It is rather prospective. So therefore, in the earlier years, that is up to AY 22-23, you will have to take your own call. You may offer it as a capital receipt, not liable to tax, or you may offer it as capital gains liable to tax at a concessional rate, or you may offer it as a profits and gains of business or profession if you are a frequent dealer who could be considered to be in the business. The second amendment in VDA which is made is that if you were to gift this, if you were to give this cryptocurrency or NFT or such other asset to any other person who is not a relative, then this would be considered as a gift of a property defined as a property under 56(2)(10), and the recipient thereof would again be liable to be taxed, in his hands. But I am afraid at this point of time in the hands of recipient, the normal rule of regular taxation and the rates of taxation should apply, and the 30% rate should not apply, because in his hands it is not an income arising on transfer by himself. And therefore I would take a view, though there could be another view which is also prevailing in the few days post budget, that it would also be taxed at 30%, but I would not like to take such a view, and I would take a view that it would be taxed at the ordinary rate. The third amendment is in relation to the TDS. When we come to TDS, we'll cross the bridge. One second. Yeah. The next is again an important amendment. All those companies which had made investment in the shares of foreign companies and were holding shares, were holding shares of the ownership rights of more than 26%, then in such case, the dividend which it would receive from such foreign company was sought to be taxed at a concessional rate of 15%. With effect from assessment year 23-24, such dividends will be taxed at the regular rates and will not enjoy any concession of 15% rate of. 179 is otherwise a difficult proposition which seeks to recover taxes, unpaid taxes of company from the directors when the company is otherwise a private company, a closely held company. Now, in such case, an amendment is made that not only tax, interest and penalty can be recovered, cess and surcharge can be recovered, but even unpaid fees also can be recovered. Now, who is in the North Block is conceiving such amendments and spending everybody's time, and is also valuable printing ink. He alone should be congratulated for doing such things. Next is TDS. The first one important amendment which is carried out and which I have taken it out for your reference is because I have serious issues with this amendment. This is about section 194IA, which provides that when you purchase a property, an immovable property which is in the form of land and building, and the value exceeds 50 lakhs of rupees, then in such case the buyer is required to deduct tax at source of 1% on the amount paid or payable. This is how it would go. And gracefully it was clear in everybody's mind that the amount that was to be deducted was qua the agreement value. So if there was an agreement for purchase wherein the agreement value was 60 lakhs of rupees, 60,000 rupees were required to be deducted. Now the difficulty is coming through this government's amendment, which applies to the current year too, which again is an issue with me, is that I have already purchased such a property of 60 lakhs rupees and the stamp duty value is 1 crore of rupees. I have paid the stamp duty at 1 crore of. My wife has purchased a similar property for 60 lakhs of rupees and the stamp duty value of that is 65 lakhs rupees. She has also paid tax on it. Now, in such cases, I would be now required to deduct tax at 1% in respect of a property which is acquired, the payment which is being made. And I have not deducted tax, or I have deducted only 60,000 rupees. So as my wife also deducted. Now this government is telling me that that I need to have deducted tax on stamp duty value. That is 65 lakhs rupees or 1 crore of rupees in both the cases. So forget that it is made retroactive. But even in ordinary circumstances, my difficulty is that how could you ignore that in the provisions which provide for substituting the SDV stamp duty value like 50C or 43CA, they themselves provide for a tolerance band, or they themselves provide for a safe harbor rule of 15%, which some tribunals have held. It could be even higher than that. Now, considering this and considering the fact that in both these provisions of 43C and 50C, there is a clear-cut provision for referring the difference to the departmental valuation officer. And on receipt of such report, if the value is to be pulled down, no addition would be made to my income. Now, here you are wanting me to deduct tax at a higher value without there being any provision to make a quick reference to DVU. Now, that is, in the absence of it, I would believe that the government should be kind to hold that such an amendment should not be seeing the light of the day. That would be the correct thing. The third issue which is arising out of it is, should I take this 1/4/2022 as an absolute date because it is in the regiment of tax deduction at source and it is not in the manner of assessment, and therefore 1/4/2022 should be considered as an absolute date and not as the date that is applicable to assessment year 22-23. You might feel that I am cynic and why this doubt should arise. The doubt arises in the matter of TDS only because most of the TDS provisions are introduced with effect from in the middle of year, that is with effect from 1st June or 1st July or 1st October. Be that it may be, this is a doubt which has been placed. I hope that I am proved wrong and the amendment is introduced. Otherwise, if not withdrawn, then it is introduced from 1st April 2022 as an absolute date and some provision is made to respect the tolerance band or the safe harbor rule. The next is about TDS paying higher, deducting higher TDS or collecting higher tax in cases where the payment or the receipt is from non-filers. Two amendments are made. One is to say that in cases covered by 194 IA, IB and M, higher tax need not be deducted. Higher tax need not be deducted. So it is so in case of 194B also. So there are four provisions of TDS of Chapter 17B in respect of which 206AB or 206CCA would have no application. The second amendment which is sought to be made, which will have application for the TDS matters only, and what is provided is that if a non-filer, it can apply to TCS also, but I am reading it in the context of TDS, is that in case of a non-filer, so far the provision was that a person would considered as a specified person, that is a non-filer, if for two preceding previous years he has not filed his return of income. He has not filed his return of income. This threshold of 2 years is now pulled down to 1 year. So even where a person has not filed return for one preceding previous year, he would then become a specified person to whom a payment is being made outside these four provisions of Chapter 17B, and the tax would be required to be deducted at a higher rate. This we have covered. Then this is again a very interesting thing. This I believe is on the lines of or in continuation of insertion of explanation 3 in section 37(1). In short, what it is provided is that if I were to make a payment which is benefit or a perquisite for a resident, monetarily or otherwise, then in such case, if such a payment would be considered as an income in the hands of the payee under section 28(4), then in such case, I am required as a payer or a giver, are required to deduct 10% of the value of such benefit, and of course the beneficiary would get credit for such TDS provided the value of the benefit is exceeding 20,000 rupees, and in case of individual and HUF the limit would be 50,000 rupees. Now provided in his case he is not required to be subjected to tax audit or his turnover is not exceeding 50,000, businessman and a professional 50 lakhs of rupees, 1 crore or 50 lakhs. Correct me if my numbers are not correct. So it is here that that now what would happen is that if your client were to gift you something in kind whose value is exceeding 20,000 rupees, and then you happen to be a person who is otherwise whose gross receipts exceed 50 lakhs of rupees, then in that case the client while gifting you will have to either deduct tax or will have to ensure that I as a recipient make tax. The client will have to ensure that I pay the taxes while filing the return of income. The same would be the case for doctors and many others, who have been otherwise habitually receiving such things, non-monetary consideration. Say for instance, somebody is taken on a overseas tour and a handsome amount is paid. This amount it would otherwise be taxable as an income of the medical practitioner and or whosoever is the professional. I'm sorry, I'm not choosing any particular profession. It simply is I'm flowing with the amendments. So this is what is the next provision in the matter of TDS. Taking further this virtual digital asset. In such case that there is a liability to deduct tax at source. The purchaser of VDA is required to deduct tax at 1% where the threshold exceeds 10,000 rupees as against the 20,000 in the earlier cases, and that is 194R, this is 194S, and in case of payment exceeding 50,000 to specified person, this would be so. A specified person is carefully defined, no exceptions are provided for. These provisions would not apply in cases of 194O, 203A and 206AB also. The last thing worth noting about it is even in such cases when the payment is being made in kind, including by use of another VDA, then in such case the payer will have to ensure that he deducts tax to the extent of the cash payment, assuming that part is paid in cash and part is paid in kind. And when everything is paid in kind, the only thing which is required to see is that he has to ensure that the payee pays tax in respect of this VDA transfer at the regular rate of 30%. Interest on default. This is an interesting amendment and which is signaling the kinds of amendments we can await in future. 201A is a provision which in three different circumstances provide for levy of interest. 201 is the one which treats you as a defaulter, and thereafter 2011A provides for interest in three different situations, and in all three different situations the period differs. One would start from the due date of deduction and would end with filing of return. Other one would start with date of deduction and would end with payment and such other things. In such cases, quite often the issue arises, not a major issue, but issue arises that what is the period for which the interest is payable. And obviously the taxpayer would consider the shortest period to be a period for which interest is payable. Now it has been provided, irrespective of the logic or the reason, that once an order is passed by the assessing officer, under 2011A, then in such case, the assessee has to simply pay interest without questioning the period for which it is levied and pay such an interest. This is what it is. No further argument is possible. I am afraid that whether such a provision can be sustained in an income tax act in a country, which otherwise a democratic country and which is in the year 2022. Howsoever it is, such is an amendment which is provided, which might have serious ramifications because most of us are liable, for small defaults to pay interest under 2011. And if I have no clue about the period for which I have to pay interest, there is a difficulty. It is the AO who would decide that what is the period. The next is search, seizure and survey. Now we will move little faster because the time is catching up on us and the intention is to complete whatever one wants to complete to the extent feasible. Yes. In case if we are unable to complete, all that I have to state, has been carefully noted in all about 104 slides of this presentation. And if I miss something, and if anyone has any question at any point of time, please write to me by email and I'll surely respond to them. Because such is the massive, colossal number of amendments which have been made, though there are 84 clauses through which the amendments are made, if you were to consider the number of amendments, they are exceeding 150. In fact, when I looked into the amendments which are made in 11 to 13 and 1023C, I just thought that it is impossible for me to cover these provisions even within another 10 weeks. Howsoever, having agreed to address this, August session, I thought that let me deal with this, and we have tried to do some sense, make some sense of it if we reach those provisions, those slides. So search and seizure, as I said, that as we would discuss some of the provisions, we would discuss some we have already discussed relating to undisclosed income. These are the provisions in which there are about 10 sections in which search, seizure and survey related amendments have been made. Again, this is a case which is now the board has been empowered to prescribe what is the authority and who will be the subordinate authority for the purposes of conducting survey. This is one major amendment which is sought to be made. We will spend some time, say about 5 minutes, on understanding this. Presently, when you file a return of income and you feel that you miss something, you feel that there was an error which has been detected after having filed the return of income. A return of income usually is being filed by due date, which is prescribed under 139(1). If you miss the bus and if you could not file it by due date, then in such an event, you are permitted to file a belated return which is known as 139(4) return. But outside of belated return or the due date return, if you have in filing any one of it, if you have committed an error by not including some income or including some income which was excludable, in both cases you were permitted to file a return which is known as revised return of income, and that is facilitated by provisions of section 139(5). This is in nutshell the game which moves around 139(1), 4 and 5. And if there is a loss return, it has to be filed by due date and as per 139(3). These are the broad provisions. A very new provision has been introduced, and before that we would also understand that there is yet another provision called 115 BBDE. A BBDE permits you to file a return of income by paying higher rate of taxation by due date or belated, by paying a higher rate of taxation in cases where you declare an income in the return of income which otherwise is an undisclosed income. So these are few provisions around which our discussion would revolve, would unfold. 139(4) and 5 provides that these returns, that is revised or belated, could be filed within 12 months from the end of the assessment year, for which you need to either file a belated return or the revised return. So for AY 22-23, AY 22-23, the return could be filed up to 31st March 2024. For AY 2021, the last date of filing the return would be 31st March 2022. Now it is for that AY 2021, a new window is being opened, assuming that 2021 can be updated. But this is just an example which I have taken to emphasize on you that yes, that now a new provision has been introduced to permit you to update your return, which is neither a belated return, which is not a revised return also, which is not a loss return also. It permits you to update your return. And how do you do so? That you update your return by adding some source of income which you had originally not included or had partially included in the return of income which you have not filed, you have failed to file, or you have filed but you have not included. Such an income could be added. And how can it be added and what is the period? Simple thing is that it can be added by filing a revised updated return of income, and the period by which it should be filed would be 36 months from the end of the year, 36 months from the end of the year, or 24 months from the end of the assessment year, that you could update this return. So you get a massive license to update your return, whether you call it revised or otherwise, whether you call it belated or otherwise. You would have on your own voluntarily file a return of income, which would be known as an updated return of income. Updated return of income. The condition is that you also have to pay tax along with the return, which is updated return, on the amount of income which you had originally not included, along with surcharge and cess thereon, along with interest thereon, and if the return is being filed for the first time, the fee also, if at all, if it is payable. All these things together to be computed in a very convoluted manner. To be computed in a convoluted manner for the purposes of section 140B, you will arrive at an amount which will be payable, along with this updated return. And while paying this, you have to take care that you not only pay that tax, but you also add 25% of such an amount as an additional tax. You pay differential tax, though there is nothing like differential tax, but for the purposes of understanding, it's good to understand that it is differential tax that you will pay. So originally you have paid one tax, so that is OT. Then you pay DT, that is differential tax, plus you pay AT, that is additional tax. The sum total of that, and what is this additional tax, is 25% of the differential tax. If you are filing return within 12 months of the end of the year, or 24 months end of the year, or end of the assessment years, take it the way you like it. Plus, because I like 36 months, it is simpler for a simple mind. And that if I am doing it after 12 months of the end of the assessment year, then it is 24 months. Then in that case, I end up paying 50% by way of additional. 50% by way of additional tax. And this is important that this amount is paid while filing the updated return. If you do not pay so, that updated return would either not be accepted, as is the system today in the electronics mode of filing return of income, or otherwise that return would be invalidated. It would be considered as, if you do not pay such a additional tax, it would be considered as a defective return under section 139(9). That would perhaps open a window for you to explain or rectify the error, assuming that you overcome the step of filing an electronic, uploading the electronic return, digital return. To me, that is, today it is not possible. Coming further to this is that it is not possible to revise an updated return. What you have done is final. जो भी errors आपने किया है वो एक बार कर लो, उसको सुधार लो. Thereafter you would not be able to update such a return. There is a provision for invoking 144 in such cases if you do not appear in response to an updated return in assessment proceedings. There would be an ex parte order. Interestingly, the time which should have been extended. See, today what is happening is that if you see the limit for time for issue of 143.2 note, 142.1, of course there is no time, 149, 153 completion of assessment and such other things, these time limits also will have to be extended. Should have been extended because you are now permitted to file a return within 36 months after the end of the year, within 24 months after the end of assessment year. So therefore it is logical to expect that such time limits also should be extended. If I have missed something, you may pardon me, but this is what is the reading which I have come to, that these parallel amendments should be made in such provisions also. Continuing with this is that there are about 2 plus 4, 6 plus 6 disabilities in cases where in 12 cases you are not permitted to file an updated return. Two standard things which I would put before you is that one is a loss return cannot be filed. And a loss return cannot be filed outside of due date in the garb of updated return. So this is one thing you will have to keep in mind, that you will have to have a positive income on which you are paying some tax. There could be some difficulties that would arise in case that to begin with, a person has income which is below the threshold limit for exemption, and even additional income which he wants to declare, together it continues to be below the threshold limit. In such case, I believe that updated return would not be filed. Howsoever, for the purposes of prosecution and such other, a return which has been filed by him would still be an incorrect return wherein some important income has not been included. Had he not filed the return of income, it was all right. But having filed a return of income, if there is a miss, if there is a slip, I would believe that it should be legitimate to permit a person to either file a belated return or a revised return or even updated return. Now that window or a facility is opened up. Then in cases wherein search is initiated, then for that year and 2 preceding previous year, a return cannot be updated. In case where survey is conducted, similarly it would not be. In case of third party also, it would not be possible for that year, provided something is found in some other case which is found to be belonging to the third party. Similarly is about books of account and the documents which are found to be relating to the third party, right? Then as I have said, if you have already done a case, if you have already furnished an updated, you cannot do a revised return. Then there is that in case where there are pending proceedings from assessment, reassessment, recomputation or revision, you will not be allowed to update your return. Then when AO has communicated your information, some information, that you are being tried under SAFEMA or PBPTA, that is Benami Properties, or PMLA, that is Money Laundering, or BMA, that is Black Money Act, or there is an information received from overseas governments or jurisdictions, or there is a proceeding which has been initiated. In all such cases, or you are in a class of a person who are prohibited by CBDT by a notification that you would not be allowed to update a return for a particular year or as a class of a, then in all such cases you will not be allowed to update your return. Mind you, in these cases there is no penalty. I would also take a view that once an updated return is filed in a valid manner, then in that case not only I would be saved of penalty, and I would also be saved of prosecution. I would of course not get any immunity under those other legislations which I have specified, but largely this would be an ongoing scheme of settlement of undisclosed income, an ongoing dispute settlement, or even where there is no dispute, you are welcome to come to the door of the Government of India, and as long as you do not mind paying that additional tax of 25% or 50%, then in that case this scheme otherwise appears to be interesting at least. Then in computing what is the tax payable, you will get credit for SA, TDS, TCS, double taxation relief, and JAA and JD reliefs, and such other things. If the refund is already issued, then in that case you will add back, you will pay interest under 234, 234B, 234C. C can pose some serious issues of computation, but some other time we can discuss. Surcharge cess would be levied. Fee under 234F also would be levied. With that we come to assessment. We will run little quicker now. In 143.3 there are two major amendments which are relevant for limited assesses. That is that they are that in case of the charitable trust or institutions or certain specified institutions covered by 1021, 22B, 23A, 23B and 23C, in such cases now the AO is prohibited or prevented from passing an order which is resulting in denying of exemption under any of these 6 provisions. Then in such case he can pass an order only after he has intimated the central government or he has informed the PCIT or CIT of his proposed action, and in continuation of the intimation or a reference which is made to government or the commissioner has cancelled the registration and the government has withdrawn the benefit of these particular provisions, it is only that the assessing officer can pass an order denying you the benefit of all these provisions. There was a third proviso on a similar line, but it had a very restricted scope, while this has now a larger scope and it is wider in clarity also. So therefore this is the provision as far as 143.3 is concerned. Now faceless, permit me now to summarize instead of taking you bullet point wise. The government felt just within a span of less than 12 months, that the amendment the new provision which they had inserted in the form of 144B is more difficult to understand, not only for the assessees but also for the officers and also for the courts also. The government also they understood that there were serious administrative difficulties, not only in law but in the procedure also. And now government is openly admitting to overcome all those legal hurdles procedural hurdles, administrative difficulties, a new section is sought to be introduced. So therefore what's happening is 144B is totally overhauled, revamped. Okay. 144B as is present today comprises of 10 subsections. Subsection 9 and 10 are deleted forever. Subsections 1 to 8 are substituted with new guidance. And now it has been provided that 9 and 10 are deleted. Regional faceless assessment centers are removed. Requests for personal hearing will have to be granted. And whatever lapses they have committed by not following 1 to 8 on account of subsection 9, which was the pillar of all those thousands of writ petitions which have been decided by the courts, wherein the AO had either not passed a draft assessment order, or where a draft assessment order was passed was substantially changed in the final assessment order, or where an opportunity of hearing, even though asked, was not provided. The courts had unhesitatingly disposed of all these petitions, holding them to be in violation of 144B, especially relying on 144B. And the shameless thing is that government in this amendment, it is proposing that all those lapses which took place and which permitted courts to hold the government to be on the wrong side, that 194B9 is omitted with retrospective effect. To my mind, even when you do so, you cannot do away with audi alteram partem, that is, you have to give an opportunity of hearing. If you provide for a draft assessment order, you should have. So if at all, if the intention is to regularize all those, all those lapses which have been considered to be lapses by the courts, which have been, and if the idea is to hold the court to be on wrong or in error in passing such order by passing such retrospective amendment, I would believe that it would be the most heinous step by the government. The government in contrast should have respected the court decisions and the troubles of the taxpayers, and should have said that with prospective effect 144B9 will have no play. Not because it is otherwise legitimate to seek those reliefs, because in the new prescription of subsections 1 to 8, it has been clearly now provided that a show cause notice will have to be issued if there is an assessment which is proposing change in the returned income. Secondly, a draft assessment order will have to be passed. It will have to be served, it will have to be shared with the taxpayer, and his objections will have to be considered before a final order is passed. And importantly, that as and when it is requested by a taxpayer that an opportunity of hearing should be given, it should have been given. So therefore, 1 to 8 in its new avatar, is a reasonably human provision. It would work provided the government gracefully accepts the existence of 144B9 and its condition. Recently, just about the time when I was preparing, Delhi High Court has come out with a decision in a case of Bharat Aluminium Company Limited, stating that these all cases are in violation of 144B9. The amendment now provides for assessments, reassessment, recomputation, and now under the new scheme, there will be no regional centers. There will be 4 units, that is assessment unit, verification unit, technical unit, review unit, and all of them would work independently, and all of them would work perhaps simultaneously also or at different time, but all of them would work under the centralized center which is known as NAFAC or NAFAC. So, and it is NAFAC alone which will be the coordinator amongst these 4 units. amongst these 4 units. There are provisions for issue of show cause notices and such other thing. They, to my mind, they are regimented and regulated provisions and should work in the times to come. This is a pictorial representation of how units will move, will pass on information from one unit to another for whatever worth it is. Please use that. Our office has been able to work out this pictorial representation, which I have at least found to be very useful. Then coming to faceless assessment, there is an extension as far as section 144C is concerned, that in respect of 3 parts, for DRP cases, transfer pricing cases and IT/AT cases, the introduction of faceless provisions is extended to 31st March 2024. So it will take another 2 years and more before these provisions are operational for TP, DRP and IT/AT procedure. Reopening and reassessment is again a case where under like faceless, the government is cutting a very sorry figure. If you would see, the courts are flooded, I must say, with writ petitions, not appeals, writ petitions, wherein, the courts are duty bound to take up these petitions on a priority basis, and courts are finding difficult, one high court after another high court. So in some cases, very ingenuine systems have been introduced by the court, wherein thousands of petitions, Rajasthan High Court other day disposed 1063 petitions by one order. 1063 petitions. All of these are the cases of agreed assessees, those assessees which could afford to go to High Court, and believe me, there would at least be 100 times number of assessees which could not afford and therefore could not have gone to the High Court. So this is the state of affairs as far as 147 to 153 is concerned. Some, fortunately, no retrospective amendments are sought to be made in 148A, which had been the bone of contention. Serious lapses have been committed by issuing notices under 148 without issuing notices under 148A, because any proceedings courts are holding one after another, with a sole exception of Chhattisgarh High Court, saying that any notice which is issued on or after 1/4/2021 should be 148A notice and not 148 notice. Courts are also holding that, that in cases of assessment years which are protected by 149(1)(b, notices could not have been issued under the new regime, on the garb that now the period of reopening is extended to 10 years and such other things. So therefore, friends, ladies and gentlemen, these are the provisions I have listed before you. You may please, there are 6 or 7 slides. Go through that. Sum and substance I have explained. 148B is the new provision which has been introduced to provide that no order in specified cases now would be passed without the permission of the at least joint commissioner or the joint additional commissioner or a director. So therefore now there is some safeguard which is sought to be introduced in this madness of 147 to 153. But presently these issues will have to be considered. That now, and another important amendment which we will have to keep in mind is that earlier it was provided that a case could be reopened. Case could be reopened only where the AO was in receipt of an information and 3 or 4 information, including receipt of information from the strategic unit RMS, was provided for. And the other case was that when there was an audit objection received from CAG of India. Now this list, the government has realized that this list is inadequate, and therefore in many other cases they have considered that other cases would be cases of deemed information, and therefore now there is a handle in the hands of the assessing officer to also initiate reopening in such other cases. The third major amendment in the scheme of reopening and reassessment is made is that when these amendments were sought to be made previous year, it was explained to the government that, look here, the scope of reopening which you have provided is limited. Why limited? In cases wherein the reopening was sought to be made for 10 years, what was required that was that there must be an asset which is found in existence. And what was in existence was an issue, what was an asset was an issue. There was another condition also which were otherwise beneficial conditions for taxpayers, that the escapement of income should have been exceeding 50 lakhs of rupees. Only on satisfaction of these two conditions, twin conditions, that a reopening could be made beyond the period of 3 years. Now the government, realizing that it perhaps is allowing many other cases of genuine escapement of income to escape the net of reopening and reassessment. And therefore now it has been provided that in cases where expenditure is found to have been incurred on an occasion or an event or in relation to a transaction, then in such case also a reopening would be possible. So this is now going beyond asset and covering transactions, events, occasions and expenditure relating thereto. And the second amendment also is that the quantum of 50 lakhs is now to be examined not with reference to 1 year, but it could be tested with reference to sum total of multiple assessment years for which a reopening is sought to be made. I hope that that I have in very precise terms introduced you to three major amendments in 147 to 153. The rest of it is procedural, and if you follow this, there should not be a difficulty. Then time limit, approval I have already discussed. There is one more amendment which is now we are outside the reopening and reassessment window, and now we are about to end, So therefore, and the coordinator today or the chairman of this session may intimate to me whenever he or she feels that that I have completed my quota of time and also the extended time which he or she may gracefully grant to me. Just tell me 10 minutes before that I have to end, and I would end. But most of the things which I want to cover, I am trying to cover. Yes. Somebody wanting to interact?
All right. So you can continue. We have 6 or 7 questions that I have sent to you. Okay. So you can take it up.
Yes, yeah. But is it all right if I continue for another 20 minutes, thereafter take questions for 5 minutes and close this?
Sir, if possible, we can continue for 5-10 minutes more.
Okay. I take your word. Yes, I'll complete this in 10 minutes. Take another 5 minutes for your question answers. Which I believe you have already sent to me, right? And is lying in a chat box. Yeah, is lying in a chat box. Okay. I will then, after 10 minutes, I will stop sharing, seek your permission, and then move to question answers, right? Yeah, question answers we have already taken a printout. So the next major amendment which has been made is in form of 156A. All of you, those who are keeping track of IBC proceedings, are aware that IBC has the resolution professional and NCLT and the courts have the power to even reduce the income tax demand also. The tax which is demanded, say running into 10 crores. The IBC procedure has IBC has a power to reduce it to 1 crore. Now the assessing officer are finding it extremely difficult that under what provision of law they have a power to reduce and scale down this demand. Now 156A has been introduced to provide that in such cases, as per the order of IBC, the income tax demand which is otherwise issued in under section 156 can be reduced to 1 crore. then it is case of appeals. First major amendment is in the form of 248, 246A and 239A. It's a unified thing. Earlier, whenever you deducted a tax in respect of a grossing up payment, wherein you pay net amount to the payee, that is the service provider or the provider of goods who is residing overseas, who is otherwise a non-resident. When you deduct tax at source which is otherwise not payable, the payer had a right to file an appeal under 248 in certain specified circumstances. This was a cumbersome provision that you do something and thereafter, you only challenge your own act. So now it has been provided that 248 would not operate anymore. 239A is a provision for making an application. Is a provision for making an application, not an appeal. Claiming that the tax which you have deducted was not payable by non-resident and therefore please refund that taxes, and 239A subject to compliance of prescribed conditions would enable you to get the refund thereof, right? Then the avoidance of repetitive appeals, sum and substance of the next 4 slides is good, and therefore I would like to share with you in a very nutshell. Presently also there is a provision called 158AA which provides that when there is a jurisdictional high court decision in favor of an assessee in his own case, then the department may not carry this further to Supreme Court, and till such time the issue is settled by the Supreme, or department may not file further appeals before High Court also. This is what is the provision. To replace that, now a new provision has been introduced in the form of 115AB, which is a beautiful provision which provides that if there is a jurisdictional High Court decision on a question of law and the collegium of principal commissioners and chief commissioners decide that it is a question of law which is pending before the jurisdictional High Court or the Supreme Court, and such an issue is already decided against the assessee's own case in his favor or in any other case, provided it is a substantial question. Then if there is a favorable order of the CIT appeal, this provision can be invoked for not filing the appeal for a while before ITAT, or where there is a favorable order of ITAT for not filing the appeal to the High Court, and if there is a favorable order of the High Court for not moving the Supreme Court in SLP jurisdiction or in appellate jurisdiction. So sum total of this is that as long as there is a decision which is settled on a question of law in your own case or in any other case, then in all such cases there will be a possibility of avoiding the filing of appeal on recommendation by the collegium to the commissioner, and on request of the commissioner, AO making an application to ITAT or High Court to defer the filing of appeal, of course with the consent of the assessee, wherein the assessee agrees that this is a substantial question of law. If the assessee is of the opinion that the question involved is a question of fact, then in such case I am afraid that it would not be possible to invoke the provisions of avoiding repetitive appeals. Then Dispute Resolution Committee is empowered to pass an order to resolve the dispute, but there a consequential order power to an AO was not provided. Now AO is empowered to pass an order and issue appropriate revised demand notice. Then as we have said, transfer pricing orders, whether it could be revised or not. An order passed by transfer pricing officer was considered to be not capable of revision by commissioner under section 263 by series of tribunal decisions which are listed at the bottom. To do away with that and to empower CIT to revise that order, that also has been provided. 5 minutes, please tell me to questions. Yeah. Then these are important amendments. We'll take 3 minutes on it. There are 3 major amendments which have been sought in the matters of mergers and acquisitions. When mergers or acquisitions happen, usually what happens is there is an appointed date and there is effective date of passing the order. In between, a substantial time lag is there between the appointed date, that is the date on which the companies seeking to merge think that they should merge for the purposes of economics and books of account and everything, and the date when the High Court approves that merger, which is known as an effective date of order of the High Court. Now, in between, in some cases, even 6 years are seen to have passed. Now, what happens to the entire procedure which has happened in both these companies' cases? In the case of an amalgamating company, as also in the case of amalgamated company. In the case of resulting company, as also in the case of demerged company, and in many cases, in cases of 391 to 394 erstwhile Companies Act arrangements also. Now, in Supreme Court in Maruti Suzuki's case held that any assessment or notice issued in the name of a company whose name is struck off from the register or which is not in existence on account of merger, then in such case everything will fall to null, will be considered. Now notice will be invalidated, assessments also would be invalidated, and there had been hundreds of such orders. To do away with this, now it has been the amendment 6 to provide with effect from 1/4/22 that whatever orders have been passed, whatever assessments have been completed, whatever proceedings that have taken place now, even though they have taken place in the name of a struck off company, a company which is amalgamating, even in such case, it would be considered as orders which are passed, proceedings which have taken place in the names of the successor company, amalgamated company, resulting company. And therefore, with this one stroke of pen, all these irregularities are sought to be repaired or corrected. First amendment. Second is that what happens to all those returns which have been filed in this intervening period, which I, for example, said to be of 6 years. Could such returns have to be modified, revised? Supreme Court very recently in Dalmaya Power's case stated, and earlier in Marshall and Sons stated, that in such cases, there would be a power to file a revised return even outside the limit of section 139(5). Now 170A has been specially inserted, authorizing both the companies to modify and revise their returns of income, perhaps even appeals also. And the third is 156A, which I have already discussed with. Then this is now a power has been vested with CBDT to also waive interest fee which is paid by soldiers and other persons who could not file return of income, and has been struck with this. These are penalties and prosecutions. You are requested to please look into that, and with that, with the permission of everyone, I thank you all and try to conclude my talk, and immediately I would take up those questions which have been addressed to me. Yes. The first question is from Rajiv Khanna from Northern India Regional Council, who is based in New Delhi. The question is, I'll have to read questions, so please pardon me for that. In context of the proposed section 194R, will festival and other gifts be covered? If so, what will be implication of the same for AIS? Section 190 AIS is annual information statement. Okay. Section 194 limit is 20,000, 56, 20 and years. So if I have got your question correctly, and that is the doubt which I have, and that is the concern which I have legitimately raised also, that anyone who is in receipt of any hospitality, any who had been a part of any tour or any benefit or any gift, all that, whether included in AIS or not, the provider of the gift, that is the donor or the provider of the hospitality, is required to deduct tax at source at 10% of the value of such gift in kind, or he has to ensure that the payee or the recipient pays tax thereon. Now in both these cases, see, it would be part of AIS. And once it is captured in AIS, the person would be advised and welcome to include it in his total income. I believe that I have addressed your case. If you have not included that income, I do not think that it would be a Section 68 income. It still is an income from a disclosed source which you have not included in a return of income, and therefore it is not a case covered by 68 to 69D. I am sure I have answered your question. The second is from Hemant Parab of WRC, is located at Mumbai. His question is, what will be TDS under section 194I? 194I, Hemant, is, if I am right, is for payment of rent and not sale price of 60 lakh and stamp duty ready reckoner of 64 lakh. I believe it is a case of 169S. 194IA, sorry. 194IA, excuse me for that. So I in your question is to be extended to IA. Now it is here that one will have to consider your question. As I said that, now the new law requires you to deduct tax at 1% where the value exceeds 50 lakhs of rupees on the stamp duty value. Now it's my view that that stamp duty value is something which has a tolerance band, which has a power to refer to DVO, and also there is a provision for reducing the such thing, and safe harbor rules also are there. But assuming that the government does not gracefully give in to provide for a 10% this thing window, then in that case you will have to deduct tax at source. Carrying further from your question, disclosures of sources of loans taken with effect from which date? Loan taken has nothing to do in my mind. Security deposit taken for the property rented or but that is once again is that when you rent property, then 194I should apply or IB should apply and not a 194IA. This is the way it would go about, and there is no amendment as far as that is concerned. As far as that is concerned, if otherwise earlier it was to be taken, then it would be taken. If otherwise, it would not be taken. The next is from Mr. Rajamani from Madurai, SIRC. Certain examples for items to be included for TDS under section 194 are. Here some suggest that even samples given by manufacturers to customers, such as pharma companies which give samples to doctors for use and not for sale, are to be considered. See it's to me it is very simple. If I am a customer and if I am not receiving anything in the course of business, 194R would not apply. 194R would not apply because I am a customer. But if I am a doctor and I am receiving it as a part of my profession, then in that case, if the value exceeds 20 lakhs over a financial year, then in such case the liability to TDS would apply. And I have already shared with you the examples of overseas tour, hospitalities, luncheon, banquets and suit pieces and another things, So in all such cases, even electronic goods and such other things, these provisions would be Even some companies are known to be gifting, bullions also. So in all such cases, one will have to be careful. Mohammad Shafi of Chennai from SIRC, updated return of income. If it is refund, what is the status? See, I am not against refund. If you are eligible for refund, then in paying the additional tax or differential tax, you will get credit for that. And even after adjusting that, if you are eligible for refund, you would still be filing an updated return. As long as the government's exchequer is enriched on account of the updated return, that should not be any difficulty. That is the right way of concluding. The next one is NIRC Nidhi Sharma for Gurgaon. Please share this PPT on CA Nidhi Sharma 09@gmail.com. I'll do so, but I have requested Shruti Oberoi to upload these on the institute's website so that there could be good number of beneficiaries. If they do not do so, please note down my simple email ID pradeep.kapasi even for questions @gmail.com. pradeep.kapasi@gmail.com, and Pradeep is PRADIP and Kapasi is KPASI. Next is Ashok Vora of NIRC from Gobindgarh Mandi. If debentures are redeemed during the same year, whether interest can be claimed on conversion of debentures? Obviously, yes. It's a wonderful suggestion that yes, point is that you will not be able to claim interest on your original borrowings, which is outstanding. Now, if you redeem debentures at a premium, or for some reason, if you can call it interest, which I would not do so, I may say that it is a premium, and that premium is a legitimate revenue expenditure, and that could also, if that is falling within the same fiscal year, you can claim that deduction. But I am not suggesting this, I am just confirming what you have said. NIRC Lalit Kumar Ahuja from New Delhi. In case, this is the second last question, Shruti. In case no return has been filed, filing an updated return under section 139(8)(a), is there any relevance for payment of additional tax? Yes, there is a lot of relevance. Any return which you would file after 139(4) limit, that is, take this as a gospel thing in your mind. If you file anything within 1 year, you will never be required to pay additional tax. Even if you have filed a belated return, I would not give up and not say it is an updated return, because there is no prohibition on filing a second belated return. You have Jagdish Chandra's case of Supreme Court, which says that a belated return cannot be revised. But can there ever be a second belated return within the window of 1 year is an open question, and therefore I would not consider any return filed within the window of first 12 months from the end of the financial year. Then in such case it would be 9 months. Sorry. Now see, my office is so strictly following me that it is saying it's 9 months. That is 31st December. Yeah, not March. That is what it is. Thank you for that. And there is another question which Lalit has asked, is in case notice under section 148 has been issued, still updated return can be filed. There is an express provision that it cannot be done once the assessment proceedings have begun. Only exception is in case where you have received an intimation under 143(1). Otherwise, that would be the case. The last question is from Rohit Kumar Singhania of Eastern India Regional Council, and he is settled in Sambalpur. Please throw some more light on TDS under section 194. Yeah, it's already night, so any light would be helpful. I have already said that yes, that that any perquisite or a benefit coming in whatsoever form, there have been cases even tips have been considered as a perquisite or a benefit in the hands of the recipient. There have been cases wherein a professional enriched on account of the gifts from the clients, even though they are otherwise not having any professional color of remunerating, they have been considered as an income because they have been considered as perquisite or a benefit under 28(4). So these are the cases. Foreign trips, as you have said, to a dealer, yes, it is a case of 28.4. Or business conference, yes, it could be a case of this thing, unless the conference is conceived for educating the dealers and not entertaining them, then in that case there should not be a difficulty of deducting tax at source. Offshore locations, again, as I said, that if you take people out to educate them, to train them, then in that case there should not be a difficulty. But if you take anything out for entertaining anybody, then in that case it will be covered by 28.4. There have been already some noise somewhere whereunder it is being said that in such cases, even where the tours are educational tour, a clear-cut demarcation should be made. The expenditure should be divided by allocating into entertainment expense and non-entertainment educational expenses. I think with this, see, I am thankful to Shruti and all of you and the organizers and Chandrasekhar Chitale, the chairman of the Direct Tax Committee and the president of ICAI, for giving me this wonderful opportunity for presenting my views in such a short time. I never thought that I have abilities to stand up to your demand of presenting some views within as short a time of 72 hours. Thank you so much.
Thanks a lot, sir, for the amazing deliberation, and I hope the participants would be benefited with this and they would be able to clarify their doubts with respect to the amendment. So thanks a lot, sir. Hello? Hello? Am I audible?
Yes, you are audible.
Hello?
Yes, yeah, please tell me.
Am I audible, sir?
Yes, Shrutika, you are absolutely audible, at least to me. If the question is for me.
Okay, sir.
Yes.
Yes, sir. So thanks a lot for the wonderful session. And it's really a pleasure to listen to you always.
Thank you.
So thanks a lot, sir. I'll sure upload the PPT on the website.
Thank you.
Okay, sir.
Thank you. Thank you. Thank you. Yes, please do so. Pleasure.